Well, good morning, Jaginder Rana here. Topic of the day is underwriting losses of Indian insurers. Underwriting losses of Indian insurers. The underwriting losses happens when an insurance company pays out more than claims. Then it collects in premiums, or when the cost of operating expenses is greater than the premiums collected. So underwriting losses can negatively impact an insurance company's financial health, leading to decreased profitability, a damaged market reputation, and insolvency in severe cases. So underwriting risk is the risk that an insurance company will incur losses due to changes in economic conditions on the rate of incidents. This can happen when an insurance company's assessment of the risk associated with a policy is inaccurate, or when uncontrollable factors come into play. So, some information is here about the insurance industry in India. As far as the premium growth is concerned, in the year 23-24 financial year, general insurance premium grew by 14.24% year on year to 2.45 trillion. Now, public sector general insurers saw an 8.99% growth in premium, while private sector insurers saw a 17.53% increase. So in April 2024, non-life insurers gross direct premium underwriting grew by 16.24% year on year to rupees 29,561.82 crore. The government is expected to introduce a bill in the upcoming budget session to amend the Insurance Act of 1938. So the bill could include provisions like composite licenses for insurance companies, simplified investment rules, and easier registrations for intermediaries. Now, the demand for private healthcare has led to higher health insurance premium, rising service costs, and technological advancements have also contributed to higher premium rates. Now, in modern times, health insurance has become a must. So, many of you have already purchased a health insurance policy to protect yourself and your loved ones against medical expenses or medical emergencies. So one hopes that the insurer will provide financial support when the medical need arises. So the story is not very different when it comes to another general insurance segment like car insurance. However, do you know how good your insurer is in settling claims and how long it takes for health and general insurance to settle claims? Or how many claims did they reject last year? It is important to keep track of the claim settlement performance of your insurer. If you are not satisfied with the way the insurance company settles the claim, you have the option to port to another insurer. So the next question is how to find how your insurer has been settling claims in the past. The Insurance Regulatory and Development Authority of India has released the claims payment details of general and health insurance companies for the financial year 22-23. Apart from health insurance claims, the percentage claims paid in general insurance companies also includes other insurance verticals like motor, fire, marine and other insurances. So to get a measure of the efficiency of the insurance company, it is important to check how quickly it is processing claim along with the number of claims settled. Though IRDAI's claim settlement data lists the details of the claim paid in various periods, what is most important for the policyholder is whether it was cleared within the first 3 months or not. So among the private and general insurance companies, Reliance General Insurance tops the list with 98.75% of claim settlement within the first 3 months of initiating the claim in 23-24. HDFC Ergo General Insurance comes next. The private insurer has paid 98.75% of claim in the first 3 months period. According to the data released by IRDAI, Juno General Insurance has settled 98.5% of claims in the initial 3 months period in 22-23. So this data shows how the insurance companies are performing. Because among public sector general insurance companies, Oriental Insurance has settled 91.62% of claim in its first 3 months. Meanwhile, the national insurers settled 91.31% of the claim in 3 months. United India Insurance settled 91.10% of claims in 3 months. So among standalone health insurers, Care Health and Niva Bupa Health Insurance recorded a 100% claim settlement ratio in the first 3 months period. 3 other standalone health insurance, that is Manipal Signa Health Insurance, Star Health and Allied Insurance and Aditya Birla Health Insurance, recorded over 99% claim settlement ratios in their initial 3 months of the financial year 22-23. So it is important to check how promptly your insurance company has been processing the claim. For the general and health insurance companies, the insurance regulator has mentioned claims settled in different periods such as less than 3 months to 6 months. So the most critical data is for a period of less than 3 months. So your insurance company has the highest claim settlement number within the first 3 months period, then it means the company settles more claims in the shortest possible time. So the most important thing is how companies are settling the claims and which companies are registering the losses. Which companies are registering the losses. Because underwriting loss reflects the losses incurred after an insurance company has paid out claims and accounted for administrative expenses for their insurance policies over a certain period. Let me repeat. Underwriting loss reflects the losses incurred after an insurance company has paid out claims and accounted for administrative expenses for their insurance policies over a certain period. Now, when an insurance company has to pay out more claims than expected and the premium brought in do not cover the overall expenses, it results in underwriting loss. So the amount reflects the inefficiency of the insurance company's underwriting activities. Underwriting losses mainly arise due to the result of huge claims and disproportionate expenses. However, there is possibility that an insurance firm may take a hit on profits to gain market share. Because underwriting loss, no company would prefer to go in underwriting losses. But unfortunately, no company is registering the underwriting profits as far as general insurance is concerned. So this underwriting loss is very important aspect as far as the viability of the insurance company is concerned. As long as the underwriting losses would be there, that means the company is not registering the underwriting profits and not adopting the sound underwriting practices. So underwriting income has to be there. This underwriting income means this is the profit generated by an insurer's underwriting activity over a period of time. Underwriting income is the difference between premiums collected on insurance policies by the insurer and expenses incurred and claims paid out. So huge claims and disproportionate expenses may result in an underwriting loss rather than income for the insurer. So the level of underwriting income is an accurate measure of the efficiency of an insurer's underwriting activity. That means underwriting income is the profit generated by an insurance company through its course of business. So the difference between premiums collected on insurance policies and business expenses plus claims paid out is the underwriting income. The underwriting income can be an indicator of how much new businesses an insurance company is bringing in, or how well its risk analysis process is in predicting number of insurance claims needing to be paid out. So if an insurance company can generate positive underwriting income, it is in a better financial place and will not have to rely on investment income or writing riskier policies. So when an insurance company writes an insurance policy for a new client or renews a policy for an existing client, they receive an insurance premium as payment. This is their revenue. The cost associated with an insurance company are the ordinary business cost as well as money paid out to clients when they file an insurance claim for an accident or other such events. So the difference between revenue and cost, like any business, is the income. In this case, the underwriting income. So an insurer's underwriting income may fluctuate from quarter to quarter with natural and other disasters such as earthquake, hurricane, and fires leading to huge underwriting losses. Hurricane Katrina, one of the largest natural catastrophes in US history, caused an underwriting losses of $4.1 billion for the US property casualty insurance industry in 2005, compared with underwriting profits of $6 billion in 2004. So, withstanding extreme events such as earthquake and hurricanes, underwriting income is an indicator of how well an insurance company is performing. If the underwriting income is consistently negative, the insurance company could not be bringing in enough new business, underwriting new policies, or to generate more revenues. So conversely, it can also indicate that the policies that it is writing are risky, resulting in claims being paid out often. This might shed light on the fact that the risk analysis in an insurance company is performing on a basis or individual when underwriting a policy is not accurate. So it is important for an insurance company to find a balance, because if it is constantly paying out claims more than it is bringing in through underwriting revenue, this could lead to the inability to pay out future claims or insolvency. So underwriting income is calculated as the difference between an insurance company's earned premium and its expenses and claims. For example, if an insurer collects $50 million in insurance premium over a year and spend $40 million in insurance claims and associated trade expenses, its underwriting income is $10 million. While investment income is different. Investment income meanwhile comes from capital gains, dividends, and other investments related to the purchase and sale of securities. So it is important when analyzing an insurance company, including the company's management, that they not look at the overall income or profit, but also focus on underwriting income to determine how well the business is performing through its core operations. So basically, the underwriting income is the underwriting cycle. The underwriting cycle is the periodic rise and fall of the insurance industry's underwriting income. So the sources of this cycle are not completely clear. However, since the swings in investment income are mild, fluctuations in underwriting income drive this cyclical rise and fall. So the number of insurance companies' insolvencies is proportional to the fall of underwriting income. Large drops in underwriting income can indicate that the underlying insurance policies are underpriced in the market, or that the insurance companies are writing riskier policies resulting into losses. So insurance companies with solidly performing underwriting income are generally stronger financially because they don't have to make up for poor performance by increasing their risk on the investment side of the business or by underwriting riskier policies. Thank you very much.